the ability and the willingness of the rest of the world to finance our consumption, because essentially what we're doing is we are selling off the crown jewels. So we are getting foreigners to buy US assets, Nvidia stock, Microsoft, treasuries. And I'm not saying treasuries are the family jewels, but certainly Microsoft and Nvidia are, so that we can overconsume, so that we can get on a plane and go to Santorini and stand on a hilltop and do that. That's what is happening. The US is borrowing trillions of dollars a year to fund spending like a drunken sailor. Now, you might refer to that as exceptionism. I don't. Right? I don't. It's a temporary high. And because at some point, those dynamics will change, because we won't not be able to give the returns to investors, foreign investors, that they demand to keep doing that. The dynamics may change. They may need their own money to spend it on other things, right? There's going to be a limit at some point. If the German government turns around one day and says, we actually really need to start investing in Germany, where's that money going to come from? It's going to come from German savers who've got their money invested in Nvidia at the moment, right? So, all of these dynamics are quite precarious. Does it change immediately? No, not necessarily, right? But just understand what's at play here.
On this episode of What the Finance podcast, I have the pleasure of welcoming back Julian Brigden. So Julian is the head of research at Macro Intelligence 2 Partners. So Julian, thanks so much for coming on the podcast today.
Pleasure, mate. Pleasure. Nice to be back.
No problem. Looking forward to the conversation. We always have a lot to talk about, and now more than ever.
Yes.
What is your current outlook on what's happened in the world? Obviously, lots happened since the Trump election.
Ooh, yeah. Look, I think this is a really very, very interesting time, and we set out to our clients of what we think is kind of a 3-stage process in this whole sort of Trump election victory, because I think people don't appreciate that actually there was a fair bit, and still if you look around at the current data, Anthony, there was a fair bit of economic weakness. I mean, particularly if you look at the labor market, companies had really stopped hiring. They hadn't fired, which was great, but they'd completely stopped hiring. And so I think heading into the election, you were looking at a very binary outcome. I think if Harris had won, I think you would have quashed animal spirits. And I think there's a risk that you would have seen firms start to lay people off. And I think that would have driven us into recession. I think with Trump, we have a possibility to pull back. And let's see if those animal spirits are enough to keep the game going for a while. The problem being that some of the assumptions of the markets are still, I think, misplaced. So we've run with this concept that Trump 2.0 is going to look very, very similar to Trump 1.0. I'm not sure that I agree with that. We can talk about that in a second, but that's kind of phase 1. Phase 2, I think we're in now, where we're looking for confirmation from some of the softer data, the more actively updated data in terms of things like the purchasing manager survey, so the sort of industrial surveys that we do, some of the CEO confidence data, some of the consumer confidence data. We want that data to sort of confirm what we assume, that, in other words, we're going into this period of strong economic growth, because we ran with a trade where we bought stocks, we sold bonds, yields rose, and we bought the dollar. So those are all kind of that strong economic. Trump is repeating what he did in his first term. I think there is a reality, though, that may strike in early next year, that this is not the case. And I think it's in part because people don't understand what Trump is trying to achieve, and also because they misread what happened in his first term and ascribe it to him, where actually a lot of it wasn't. So I think the reality of conditions early next year may come as a bit of a shock to markets, and some of the assumed trades that we're doing now. And I think there's right here, right now, I think this sort of consensus trade that everything just runs up into year end. I don't know. I'm looking at some of these things and they're at big levels, Anthony, right? Very, very big levels. And there's some vulnerability here. So I just don't see, if you're invested in markets, great, right? Great. You've had a good run. But I don't think these are levels that you enter into new trades here.
Okay, makes sense. A lot to unpack there. So I'd be interested to hear why you think Trump 1.0 was very different or will be very different to what Trump 2.0 is going to be offering.
Yeah, so I think there's a couple of things. So I've got lots of policy friends who, from my days when I worked on that side of the fence, and people assume that Trump's only sort of concern is just this rampantly bullish economy and a rampantly bullish equity market. That's not really true. What he's trying to achieve, so I'm told by my friends who do this policy analysis, is there's really about reversing some of the negative effects of globalization. So in other words, this is kind of a manifestation of sort of some of the trends that we've seen from Brexit, to Berlusconi in Italy, to, this sort of extreme hollowing out of global manufacturing in the Western world and offshoring to places like Mexico or China or Eastern Europe, right? And so there is an attempt to reverse that trend to benefit American, in this case, workers who feel like they've very aggrieved. And that is his constituency, right? Let's not forget. His constituency is not corporate America. His constituency are these individuals. And the intention in his first term was to try and do that and to offer tax incentives to companies that re-onshored profits and re-onshored investment. And the problem is that he introduced it via a tax bill, and that had to go via Congress. And as soon as it went into Congress, the sticky little fingers of all the lobbyists got involved, and they stripped out all the conditionality. So in other words, we'll give you a tax cut if you bring the money home, right? And you invest in a job or a factory. And they just gave a tax cut to everyone. And this time, the approach is much more stick. So he is going to use the stick of tariffs to force companies to bring jobs home, to make it uneconomic for you to import, make in Mexico or make in China. And I think people assume that that's negative for China and Mexico, and maybe it is, right? Probably is. But I think we have to think of who the target here is. Everyone assumes, well, this is just anti-Mexican and anti-Chinese, but they were just the beneficiaries of a decision that was made not by them. They didn't decide to steal all those jobs. Corporate America decided to outsource those jobs. So the target here is to change the behavior of corporate America. And I think everyone assumes it's just going to be wildly bullish for corporate profits, and it probably will be for certain sectors. But what about all those sectors that suddenly find that their cost base has gone up because they're having to deal with higher tariffs? Right? Profit margins for certain sectors could go down quite dramatically, and costs are going up for everyone.
Okay, so yeah, that would obviously affect many equities in the markets. I know Apple have talked about how the cost of an iPhone will sort of double if they had to do that or something like that.
Yeah, but I've heard things. Look, and I get it, and maybe there are some carve outs. But the other thing is everyone just assumes that this is just a negotiating tactic, right? Well, firstly, as I said, this is designed to elicit a behavioral change, so I don't think it is. And secondly, tariffs are an integral part of funding the tax cuts. So if he doesn't want the tax cuts to occur, which he does, right, then maybe we don't have to have the tariff increases. But he wants the tax cuts to occur. So you're going to get those tariff increases. because without them, he can't pay for the tax cuts. And he has a razor-thin majority in the House of a quite fiscally conservative group of Republicans. So he has to find what they call as pay-fors, right? And tariffs are going to be a huge chunk of that. So this whole idea that, oh, they're all going to go away and it's just negotiation is a fallacy.
And I guess some people would say, oh, but they're going to come in and cut out a large portion of the costs, and it's probably not going to be 2 trillion as some people say.
I mean, but maybe. I mean, look, you're not going to get 2 trillion, right? No. I mean, look, the rolling over existing tax cut is like 4 to 5. The additional are another 2 that he's talked about, so that's 7. So maybe you can cut 2 from government. Good luck with that one. Maybe you can, where else are you going to find the rest, right? You can simplify some tax codes. You can do some stuff. You can cut out some other stuff. Maybe you can get to, 2.5. But 2.5, the only other place you're going to get is from tariffs. And 2.5 over 10 years, 2.5 trillion over 10 years. Let's really do simple maths. Let's call it 250 billion, right? It's coming from tariffs a year. Right. And that's 8 to 10% on everything, or a lot more on China. I mean, how that exactly gets figured out, we don't know. Right. But it's coming on. If you start excluding bloody everything that moves, right, you're not going to raise the money.
Okay. So you see it as actual money raising mechanism.
So
which is, I guess, a lot different.
It's designed to, what I'm being told by my policy friends, this is designed to elicit a behavioral change, to force manufacturing back into the US, by making it uneconomic to produce abroad, to strengthen both the US economy and the US, call it, defense standing, right? Because we don't want to be producing too reliant on imports, right? Because we are in this increasing Cold War with China, right? And not only is it that, but it is designed to fund tax cuts. You can't get the tax cuts without the tariffs.
And this is, I imagine, quite negative for the surplus exporters who, trade exporters like Germany's, like the China's.
Yeah, I mean, it's definitely, look, depending on how it's divided up, Anthony, right? So, is it 10% on everyone, an additional 10% on everyone? Is it 50% on China and, a few percent on everyone else, right? We don't know the details, right? And the devil is going to be in the details. But don't think this isn't coming, girls and boys. This is definitively coming. This is not a negotiating stance.
Okay. And I'd imagine that you'd think that is quite inflationary for the US. Is that sort of globally inflationary as well?
Yeah, I mean, it depends. It depends on how you. So let's just play a simple game here. So let's say you produce a spanner in China at the moment, cost you $1, right? Let's say they apply a 50% tariff to that. Okay. So suddenly it costs you $1.50. But let's say that's roughly what it costs you to produce a spanner in the US, right? So you're kind of equal. But you go, it's a pain in the ass. I don't want to, rejig the factory and I don't have to find workers and, all this sort of thing. And then the Trump administration goes, but we'll give you a 15% tax cut. So suddenly it costs you $1.35 to produce it in the US as opposed to $1.50 to produce it and import it from China. And then you go, okay, well, I'll open a factory here in the US. Well, great. That's what the Trump administration wants. But it's suddenly costing you $1.35 versus $1 before. So who eats that 35 cents? Do you pass it on via price increases, or do you eat it in margins? Right? Neither of those are great. Like, one's pretty inflationary, right? Particularly in an environment where almost all of the disinflationary impulse we've seen so far has come from the goods side of the economy? Or do you take it as a hit to corporate margins because you don't have pricing power? So that's going to be very idiosyncratic, but neither of them are good.
Yeah, so I guess historically, if we look at what the US and what other Western countries have seen is, product deflation while services inflation. Do you think could this be a shift between of that, or do you think this would be sort of both?
Well, we have that at the moment, Anthony. Right? I mean, I've been saying to clients, I mean, it's bloody fast to believe that we've cured inflation. Right? We have core service inflation at almost 5%. Right? That's the highest in 30 years. Right? So don't tell me that we've cured inflation, because core services are the vast majority of core inflation, right? So what's dragged down core inflation heavily has been falling goods prices. Again, we were back in outright goods deflation. They're falling at over 1% per annum. But historically, that's not the norm. This is the second lowest rate in over 60 years. And they typically, over the last sort of 20 years, have kind of averaged about zero, right? So even if they went back to zero, that would be bad enough, because unless you get an offsetting weakness in the service side, which typically is linked to a weakness in the labor market, by the way, so that's another problem we'd have to face. But unless you get that, if you went even back to zero, you'd be pushing core inflation higher again, right? So then forget your rate cuts, right? But if you then turbocharge that price increase by putting tariffs on those goods, you could catapult core inflation higher.
Yeah, and I guess a lot of people might say that, they're going to try and pump more oil, more energy. That's what they're looking for. That could potentially benefit. And
maybe,
the US
but we
is
can
very unique.
Sit in this game and go, what if all day long. If you look at the price action of most assets post the election, right? We've had a big run in stocks, big move in bonds, big move in the dollar, big move in crypto. Did oil not get the bloody memo? Oil hasn't moved. Sure, it hasn't gone down. Right, so someone in the oil market just doesn't believe, that either the Trump administration has the ability to deliver, or they're just taking the other side of that trade. I mean,
yeah, when you have 4 million barrels a day of overhang from OPEC waiting for prices to go up.
I mean, look, there are ways. I mean, you can do it. Don't get me wrong. I mean, you could give a tax incentive to reduce the cost of US shale producers or oil producers, but to get it down to to get it down $20, right, which get down to 45, costs you about $100 billion a year. And that's a one-off. That's a one-time gain in inflation, because you do it year over year, and it costs you over 10 years. It costs you $1 trillion. So you're going to take 20% of all the revenue you're going to try and raise and give it away to oil companies for a one-time gain on inflation. I mean, maybe they can lean on the Saudis, but are the Saudis really going to do that? There were just some holes in these plans.
Yeah, when shale sort of break evens around the mid 50s, you can't see, it'd be hard for production to stay that high.
I mean, I think you could probably get a little bit. Don't get me wrong, but as I said, the oil market seems highly cynical or skeptical because the damn thing hasn't gone down at all.
Yep, definitely. So then if we go to, I guess, the Fed, would you say that Powell's cut too early, or he's gone too aggressive to start with? Or
look, I think he's the thing with the Fed, and I think people have to remember this is one of the few dual mandate central banks, right? They have an inflation and employment mandate. Most other central banks do not. Most other central banks have simply an inflation mandate, which is why when you look around the world, most of the other central banks have been much more cautious up until very recently about cutting rates, right? Much more hawkish. I mean, to take an extreme, when you look at, say, New Zealand and the Reserve Bank of New Zealand, this is a central bank that turned around publicly and said, to New Zealanders, stop demanding pay increases and raising prices. Otherwise, we will shove you into recession to kill inflation, right? That's our mandate, right? Now, you could never imagine the Fed turning around and saying, stop raising prices, corporate America, or we're going to shank the stock market till you do, right? So I think we have to bear that in mind. But this is a central bank, right, that still has an inflation mandate. And I believe, at least for now, that Powell is serious about trying to deliver. So given what we're seeing in some of these forward production indicators and some of these confidence metrics that we've seen post the election, I mean, if they're real and they do manifest themselves into real economic activity early next year, then maybe you've got one, maybe two more cuts and you're done, right? And this is, I think, the big discrepancy to the equity market. You know, I keep hearing everywhere, oh, you know, we're going to get this booming economic growth courtesy of Trump, but we're also going to get tons of rate cuts from the Fed. On what planet? Like you make a choice, right? If you don't get growth and we go into recession, fine, you can get rate cuts. But if we do get growth, particularly with 4% unemployment, like post-war lows in unemployment, why would you, and you suddenly get growth, why would you get rate cuts? Like, God forbid we get, as I said, inflation because we get tariffs, right? Even just taking that out of the equation, if you just get growth, why would you get rate cuts?
Yeah, unless, that would be going back to, I guess, the Greenspan put and, you know, saving the markets, which I don't see Powell.
Yeah, but then the market's
having
got to be down first, mate, right?
Yeah,
you don't
true.
save the market at the arse high. You don't save the market at absolute historic highs. You save it when it is down, right? And Greenspan's put was all about tackling deflation, right? When he came in 98 and came in with the put, it was for the first time that the Fed was concerned about the zero bound. So in other words, rates have got to basically heading towards zero, and then they run out of ability to kind of influence the economy at that point. And they were trying to, they were concerned in that environment about, you know, an indebted society of deflation becoming entrenched. Okay. We haven't got bloody deflation. We've got inflation, right? That's when you prioritize for the equity market, and that's when the put exists. In this environment, you have to prioritize for the bond market, right? Because you lose control of the bond market and you're in real trouble.
And do you think they're worried about the bond market?
I think they're clearly worried about, they should be worried about the bond market. I mean, you know, the incoming Trump administration, means, you know, Scott Bessent's on the record for saying he's worried about the deficit, right? We have to be, right? You know, the lesson that we took away from, you know, the Liz Truss moment, you know, when the UK government tried to spend money and the bond market went, no, you don't, right? That haunts every logical central banker and finance minister in the world, right? They'd be bloody stupid not to be concerned about it, right? Now, you know, does Trump necessarily think about it all the time? Maybe not, but the guys around him who are smart, who definitely think about it, right? So they have to be concerned about this. They have to address the deficit, right? And that's another thing. I think, you know, everyone's assuming that this is just going to be a painless process. Well, Elon Musk told you, you know, we've got to be prepared for some short-term hardship. Really? Is that an equity market sitting on the arse highs? You know, no one's listening. Everyone's assuming that they know what next year looks like. I don't think we've got any clue until we find out the details of the policies. But there's ways I see them setting up. I don't think they're as positive on risk assets as everyone assumes.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in and for your support over these 3 years. So we've had, you know, hundreds of guests that we've welcomed on the podcast. We've had millions of views. We've hundreds of thousands of different people listening in. So I just wanted to thank you. You know, I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Yeah, okay. I find it hard. I think if and this isn't saying the US isn't in a bad position, but it seems like other countries, especially in Europe, are in sort of worse positions. So you wonder, do you think it would be this Avalanche, or no? You'd say it'd have to be a circumstance by circumstance basis.
I think when I look at equity markets, they're at some hugely big, long-term levels. So I'm not, we've had this money piling into the US. We've called it, a reflexive cycle. So it's sort of self-reinforcing cycle. The conditions for that to continue look like they're still in place. But I think it's quite a fragile setup. So if you mess with it too much, it could unwind quite hard. As I said, doesn't look like you're about to, unwind it. But there's going to come a point where the ability and the willingness of the rest of the world to finance our consumption, because essentially what we're doing is we are selling off the crown jewels. So we are getting foreigners to buy US assets, Nvidia stock, Microsoft, treasuries. And I'm not saying treasuries are the family jewels, but certainly Microsoft and Nvidia are, so that we can overconsume, so that, we can get on a plane and go to Santorini and stand on a hilltop and do that. That's what is happening. The US is borrowing trillions of dollars a year to fund spending like a drunken sailor. Now, you might refer to that as exceptionism. I don't. Right? I don't. It's a temporary high. And because at some point, those dynamics will change, because we won't not be able to give the returns to investors, foreign investors, that they demand to keep doing that. The dynamics may change. They may need their own money to spend it on other things, right? There's going to be a limit at some point. If the German government turns around one day and says, we actually really need to start investing in Germany, where's that money going to come from? It's going to come from German savers who've got their money invested in Nvidia at the moment, right? So, all of these dynamics are quite precarious. Does it change immediately? No, not necessarily, right? But just understand what's at play here.
So you see in the long term, the financial repression is similar to what was seen in sort of the 70s and 60s. And
look, mate, to deal with the deficit, there's kind of three options, right? Option one, you default. Not a very good one, and an unnecessary one if you own your own currency, right? Because you can always print. Option two, you print, right? You do directly suppress. So you come in and you do yield curve control. You slap down bond yields till they're artificially low, and you do what you did during the post-war period, right? Where you just say your name's the Fed, 10-year Treasury yields are 3% now, sod off for the next decade, right? Or option number three is you kind of financially repress, and ideally the way that you do that, that means basically bond yields sit below nominal GDP, so real GDP plus inflation. And you can do that for an extended period of time. Now, the way that you want to do it is running growth, which is what the Trump administration wants to do, running growth real growth very strong, right? So running the real economy really strong. So let's say we got 3% real growth and 2% inflation and 4% bond yields, that will work. But you could do it the other way around, where if you can't get the real growth, you run 3% inflation plus 2% growth, right? And you get to the same end game. But yeah, you have to, those are the only three options you've really got.
Okay, that makes sense. And then if we go to the dollar, it seems to surprisingly have ripped despite many of these things seeming the Trump trade seeming to be negative. Dollar, I don't know if you agree with that or no.
I mean, this is always the inconsistency. People were like, he wants a weak dollar. Well, you can't. If you end the current account deficit of the US, right? The way that the reserve status works is a reserve currency works is the rest of the world buys or holds dollars in reserve. How does it get those? Well, it gets them either they borrow them from the US, which is a pretty precarious thing to do, right? We've seen that with emerging market crises in the past where, someone like Latin America goes and borrows a lot of dollars and then all of a sudden finds out they haven't got any and then the thing blows up. And typically the US runs a large current account and frequently budget deficit, and that floods the world with dollars, right? And the rest of the world gets in this kind of vendor financing game. So they export products to the US. The US gives them dollars. They take those dollars and they reinvest them in US assets to continue that funding. And that's what we're doing kind of at the moment. But the problem is if Trump wants to collapse the current account deficit, then either US banks are going to have to start lending abroad dollars a lot, or we're going to squeeze that supply of dollars to the rest of the world and then the dollar goes up, right? At least in the short term. Right? What it would do as our ability to be the reserve provider, and I suggest not being the reserve provider would be a very, very, very bad thing for the US. But no, this is bullish. And then you add in, the interest rate differentials, which is the main thing that's been driving this, right? I mean, this is very pro-growth conceptually. The assumption is this is a very pro-growth. As I said, we'll see early next year whether it actually turns as pro-growth as people envisage. But the assumption is this is a very pro-growth environment. So interest rates in the US have risen more than in Europe, and that has supported the currencies and likewise in a lot of the other currency pairs, which is why the dollar's been strong.
Does sound like a dollar wrecking ball, sort of, at least in the short term.
It's not really, because the typical, what I refer to it as a napalm run, is a real wrecking ball for the dollar. Typically occurs at the last stage of just before things start to really break. So you're ending up with a risk off move. So you get, let's say stocks are falling and the dollar is going higher. And the reason why that's so toxic is because the dollar is the denominator of most of the assets that we own. So as it rises in value, those assets fall in price. So think of like commodities, right? As the dollar rises, commodity prices fall. So not only do you have a bear market in risk assets, but then you have the denominator of those assets rising, so they fall even further. So it really is what we refer to as a napalm run, because at the end of the napalm run, if you let it run too far, if you let that dollar rise too far in those environments, all you're going to end up with is a bunch of charred bodies and smoking holes. So it's a really disastrous scenario. This isn't like that because we don't have a risk off move. We have a risk on move with a strong dollar. That's not the same thing.
Okay, so if economically shit hit the fan, then that would exacerbate the issue. And
I mean, conceptually, right? It depends on where the money is, right? Because you end up with a risk off move this time. I think in some cases, say for example, in the yen, I think if you had a risk off move, dollar yen would fall, the dollar wouldn't rise, right? Because there's a lot of Japanese money here in the US. I think there's a lot of European money here in the US, right? So you could find that the euro actually didn't fall in a risk off environment. Maybe it would even rise. It would certainly rise, I think, against some other assets. But that's all about positioning in that at the end of whatever that risk run is.
Okay, that makes sense. I know you've been quite bullish on sort of precious metals, and yeah, it seems to have done quite well. So do you see that as sort of another risk off asset, or just a diversification against bonds?
Look,
How do you sort of see it?
I use precious metals and recommend it to my clients as a preservation of wealth. I don't think that fixed income, certainly in the US, has been doing that for many, many years. I see that as an alternative to fixed income, and treasuries is massively outperformed, even allowing for coupons. So, interest earned outperformed the price action of the treasury market. But I'm not naive enough to know that if we were to go into a broad risk-off environment, at least initially, that precious metals are owned by portfolios that take risk. So if you end up in a situation where you have a broad risk-off move, so stocks are falling, right? I think precious metals could outperform, to use the lingo, right? But what do I mean by that? They could go down. They might drop 10%, 20%, but it might go down less than equities that might drop 30 or 40, right? Now, I don't like assets that go down, even if I'm better off owning those than I am stocks. I just rather own cash. So I think long term, and the one thing that will cause a true precious metal, true bull market is a much weaker dollar and a Fed that starts to cut rates very aggressively. And the only way that I see that happening is a recession and a bear market in stocks first.
Okay, so if that were the case, then yeah, further bullishness in.
Yeah, I mean, look, historically, mate, if you go back on true bull markets in precious metals are born out of absolute bloodbaths in equities. So you're looking at the 1930s, the 1970s, and the 2000s, right? So like 40, 50 plus drops in stocks. That's what gives you true bull markets in precious metals.
Which rip first what we've sort of experienced this recent bull market, which has been sort of more of a slower rise.
Yeah, it's just kind of like a rise in everything, right? Don't get me wrong, they've outperformed. I like them. I think there's a lot of this sort of strong hand, weak hand, central banks buying, type thing going on. But this is not a true bull market in precious metals. Gold has held its own against the S&P. It hasn't outperformed the S&P. If you look at it from 2002 to 2008, it massively outperformed. If you looked at it in the 1970s, it massively outperformed. If you look at it in the 1930s, it massively outperformed, right? Not the same.
Yeah, makes sense. So, Julian, thanks so much for your time today. We've sort of covered a lot of different places. But yeah, last question is, what is one message you want people to take away from the conversation?
So look, I think we're in an interesting period here. I think that between now and the year end, we should get some confirmation that the initial trades that people have put on are right. We should get some strong sentiment data. The question is how is the equity market going to respond to what should be resultant higher yields as a result of that, right? This scaling back of Fed rate cuts. Can equities take that, or do they start to correct and we see some sort of dip? We'll watch the bond market for clues to that, because that has to be the driving force. And then I think next year, as we roll into it, we really, really need to see the details, because I think this assumption that everything is just going to be rosy, I think is really naive. I don't think people understand what the policymakers are trying to achieve here. I think this is a generational pivot here. I think that is really important to take away. And so I think, and these, when you look at levels, et cetera, these are not levels where you commit a ton of risk, right? These markets are extremely high. They're extremely expensive. If anything, these are levels where you run very, very close risk, tight stops, or you raise a little bit of cash. And then you look to, deploy it when assets sell off, right? I mean, that's kind of my approach at the moment. I have a reasonable chunk of cash.
Great, makes sense. Thanks so much. If anyone wanted to find out more about your work and what you do, I think you have a new service.
We do
about it as well.
We do, yes. So we have this new product. So we did a long time, as you know, we were doing stuff with the Real Vision guys, and Raoul and I sort of decided that we were sort of going in different directions. So we would focus ourselves, and we wanted to focus our own product really on the macro and not kind of get involved too much in the sort of crypto space, which Raoul done very well in, but it's not really our thing. So we've launched a retail product called Macro Capture. The whole idea is to try and simplify macro, which is really bloody hard, right? I've been doing this for many, many years. My whole team has got like 200 years of actually trading markets, not just talking about them. So we've launched that. And if you're interested in that, go to the MI2 Partners website or contact us at support@mi2partners.com, or just follow me on Twitter, which is Julian at MI2.
Great, perfect. I'll put that in the description, but thanks again for your time.
Pleasure, mate. Thanks.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.